And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the Hump Day edition of The Real Investment Show. So glad you're here this morning. And what a day yesterday. I feel like I should come in this morning with my Hulk Hogan outfit on. You know, it's like, listen to me, brother. We were talking yesterday about, you know, the market was a little bit overbought, slowing momentum, relative strength. And we said, hey, you know, be careful going into September. Tends to be a little bit rougher time of the month. And quite the sell-off yesterday. We'll get into that in a few minutes and go through the technicals of it. But some other big news out yesterday morning, of course. We had two manufacturing reports out. So we had the S&P Global Index out yesterday, which nobody really pays attention to. But it actually showed some slowing, and the internals of that report suggested that the economy is actually slowing down a good bit on the manufacturing side. Now, now remember, this is manufacturing. We're going to talk about that, the importance of that in a second. But ISM manufacturing came out yesterday, dropped deeper into contractionary territory. And if you take a look at new orders, the employment index is all starting to show real signs of weakness, suggests that kind of, even if you look at the sales to inventory ratio, that suggests that we're going to see weaker manufacturing over the course of the next few months in particular. So there's certainly evidence that the economy is slowing down. When looking at manufacturing, now manufacturing is important. Don't evade that. But what we also must realize is that 80% of the economy is now services. So manufacturing isn't as important to the overall economic makeup as it used to be. Back in the 60s, 70s, even the early 80s, it was inverted. Services were about 20, 30% of the economy. and manufacturing is about 80%. So again, manufacturing used to be extremely important to the economy, and then we outsourced everything overseas so we could have cheaper products. We export inflation to import deflation. And so manufacturing no longer has the importance in terms of determining economic recessions as it used to. However, like I said, it's still important. Don't dismiss that. But services has not broken down entirely just yet. The last ISM services report was still in expansionary territory, so we'll see in the next report whether or not we get that falls into contraction. Now, if you start getting services and manufacturing into contractionary territory and they remain there for a month or two or three. Now, manufacturing's been in contractionary territory for 18 months. It's been there for a long time now. Services has not. But again, if we get both services and manufacturing in contractionary territory, that's going to be a good sign, not just for 1 month. If they stay in contractionary territory for 3-4 months, that's going to be a really good sign the economy is very much slowing down, and that's going to be represented in slower economic growth numbers, etc., higher unemployment. That'll be a good key indicator. Now, again, this brings up another point, right? We've been talking about this, or at least, the media back in 2022, hey, recession's here, we're going to have a recession, we never did. Now the topic of conversation is that the inverted yield curve, which is very close to uninverting, and as we've talked about before, that's the timer that starts the countdown to the recession when it uninverts. But article out yesterday in Bloomberg talking about how the yield curve is now broken, it inverted, we didn't have a recession, so you can't pay attention to the yield curve, it's wrong this time. Be careful with that, because again, it's not the inversion that is recessionary. It is the uninversion that indicates the onset of a recession. Now, we're very close to uninverting, but now, even with that, there's a trick to it, because just because it uninverts doesn't mean, oh my gosh, the recession's here. It means that the clock starts potentially for the next recession, which is anywhere from 6 to 18 months. Now, remember, a good example of this was the yield curve uninverted in 2007, and that was, of course, going into the financial crisis. We didn't realize that we were in a recession until the end of 2008. That was when the National Bureau of Economic Research, said, hey, a recession started a year ago, back in December of 2007. So timing is always the crucial factor to all of these numbers. So again, these numbers are great, these indicators are great. All they do is tell you that there's a potential for things to happen. It doesn't guarantee that something will occur. And the longer that it takes for that lag to catch up between the data and the announcement, right, the less that people pay attention to these types of data. Just understand that this data is important, but not today. Right? What goes on in the markets from one day to the next is entirely, different than what some of this data that comes out tells us to have, 6, 12, 18 months lag. People will ignore that data eventually. So, what happened yesterday? Here's what you need to know before the bell. So yesterday, we noted in the morning that the markets were overbought, we were losing momentum, and that there was a risk of a correction in September or October just because of a whole variety of risks, right? We've got the election coming up. There's going to be a lot of debate over that. We've got the blackout window for stock buyback starting on Thursday. So again, there's this going to be extraction of momentum. Well, yesterday the market sold off a lot sharper than we thought. And we noted yesterday morning in particular that what we were watching was this consolidation of price that was occurring. The market ran right into up to the previous highs. That was our resistance mark. And we said, okay, if the market can break above that, then we've got a continued run going. If we fail at that level, then we're going to have a bit more consolidation here. And the first test that we were looking for, as we said yesterday, was this crossover of the 50 and the 20-day moving average. We said that's initial support. So we should see the markets hold on to that support level if we come back to that level. Well, I certainly thought that we would potentially get a little bit of a sell-off yesterday. I didn't realize that we would do it all in one day. The markets opened down, and then we sold off all day long yesterday, with the markets actually testing and bouncing off yesterday, that 20-50-day crossover. I mean, we literally landed on it yesterday and then bounced off of it going into the close. But it was a pretty brutal sell-off yesterday. We did reverse some of that overbought condition, not enough yet to suggest that this selling pressure is over by any stretch. And most importantly, though, we're very close now to triggering that sell signal on the MACD. So again, it doesn't mean that we're going to have a massive 5%, 10% correction, whatever it is. Although yesterday was very steep, and we'll talk about one of the reasons why here in a sec. But again, just pay attention to this. I would certainly expect the markets to potentially try to bounce a little bit today. We'll see. We're going to open lower this morning, but again, I wouldn't be surprised that by the end of the day we try to see some buying coming in, particularly since we're kind of close to an important support level. If we take out this support level right here at the 20-day crossover, we're going to be looking at the 100-day as the next level of support. That's right around 53.50 on the S&P. So again, there is some downside risk here, and this is why we talked about recently, taking profits, reducing risk, etc. That continues to be the mantra here. I would use rallies, any bounces in the markets. If you haven't done that, use a bounce today, tomorrow, whenever it occurs, to reduce that risk a little bit more as we move further into the month. And again, just keep a watch on our sell signals, because that's the important thing. Now, the driver of that sell-off yesterday was all semiconductors. And interestingly enough, Nvidia was down about 10% yesterday, and there wasn't really any news for why the stock was down 10%. But ironically, the news came out after the bell, which was a DOJ subpoena that was sent to Nvidia to look at potentially monopolistic practices. The question is how did the market know about that well before the actual subpoena announcement of the subpoena was released? I guess Nancy Pelosi called her buddies. But we'll talk about more of that when we come back from the break. I'm your host, Lance Roberts. That's what you need to know before the bell. Don't go away. More of The Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. Yesterday. Welcome back to the show yesterday. I didn't sleep much last night, so it was one of those nights I had a lot of tossing and turning, and weird dreams kept waking me up all night. So It's Groundhog Day, I guess. So a couple of things. So just talking a little bit about the sell-off yesterday. Again, certainly took everybody by surprise. I guess like I said, it was kind of an interesting day. I was working. I did the show yesterday morning. We talked about the potential, for a correction sometime this month, and markets were, kind of hovering and lost some momentum, as I just said. And, those are good kind of precursors to a correction. And so the markets were looking to open a little bit softer yesterday morning, but nothing dramatic, right? It was just, we'd had a big update the day before. So, we're going to see a little bit of a sell-off, a little bit of correction, no big deal. So, I went to the gym, I worked out. I, got back to the office, did my stuff, and then, started working on the newsletter for this weekend, and I don't really pay much attention to the market during the day, right? It's, I never have CNBC on, I never have Fox Business on, I'm not obsessively checking market screens and this thing and the other thing. And people assume that's what I do all day, is like, oh, I'm just glued to a stock trading screen every minute. No, because I don't day trade. Right, we're looking to make investments that we want to hold longer term, and so I'm doing fundamental research, I'm doing analysis, and again, if you haven't taken advantage of our website, if you don't go to realinvestmentadvice.com, we publish all of our research. So everything that we're researching to manage portfolios with, we write articles about and we publish it. So our daily blog, our daily market commentary, the weekly newsletter, that's just our research. So everything that we talk about on the show, the things that kind of our themes and our theses, those are all things that we research and we publish all that, and it's all free at the website. So you just go to realinvestmentadvice.com and take advantage of it. It's a fire hose of information, so there's a lot of stuff there. But, it's to help you make better investment decisions. But so the point about all that is that I was doing some research and getting ready to start writing the weekend newsletter. And I'm going to talk a little bit about yield curve and inversions and those type of things. I think, sometimes I change my mind on, when something like this happens, maybe the topic will be different this week. But I'd started kind of putting together research for this and didn't really pay much attention to the market. And about 2:00, I kind of glanced up, looked at the market screen, and I was like, oh, what's going on here? What happened? And couldn't really find any information, right? There was no big headline reports or anything else that was driving the sell-off. And again, it was mostly it was an interesting day because we saw selling in more of the growth and investments, kind of offensive sectors, and defense actually did pretty well yesterday. Bonds had a boomer day. Bonds did very well. And defensive sectors like healthcare did okay. Now, what was interesting, though, is that, so I'm going, okay, well, what's going on here? Why are bonds doing so well? And because there was really no economic data out, there was no kind of news headlines to do that. And then you kind of dig into the numbers and you look at Nvidia and AMD and Broadcom, and they're just getting slaughtered, right? And I'm just, I'm like, okay, well, why isn't, now, again, when I say slaughtered, Nvidia was down 10% yesterday, but it's up like 900% from the lows. So, whatever. Yeah, it's down some. But, it was concentrated in that sector. And again, there was no news to speak of. And so I called Mike, and Mike and I were kind of discussing it. He didn't see anything either. And, one thing that he did bring up, particularly with bond portfolios, is that going into the end of the month, you have some positioning for end of month. So you have a lot of shorting of bonds going into the end of the month. And then when the new month occurs, then those roll over and they have to cover those shorts. And so that's could have been one of the, and again, we don't know, but that could have been one of the reasons why bonds were having such a good day yesterday, following a decent sell-off the day before, which was prior to the end of the month. So, again, there was just some of these things that were going on, didn't make a lot of sense. And then after the bell was this DOJ announcement. So now you have risk off. Now it makes sense, right? Because you have this report going after the most significant stock in the market right now, right? I mean, it's all focused on AI. The market focus is AI. You've got a lot of trades piling into Nvidia. It's had a huge run from the August lows. So it's a very important company. They just announced earnings. So it's a very, very important company. As Goldman Sachs recently stated, that Nvidia is the most important company in the market right now. And there's some truth to that because so many people are chasing it. Not only buying the individual stock, but buying leveraged ETFs, etc. So when that news came out, it made sense. You had a lot of risk off. I'm taking money out of Nvidia. I don't know what's going to happen, and I'm going to put it into bonds for safety. Complete sense. If I'm a hedge fund, that's exactly what I'm doing. My question is how'd they know? Because the DOJ release to the press wasn't until after the bell. And Nvidia will be down about 2% this morning, along with the rest of the market, because people got home yesterday and go, just like I did, like, oh my gosh, what just happened? I better sell my position, right? So you'll have some additional selling pressure this morning. But again, how did they know? Because it was apparent that somebody knew something somewhere along the way, and you had this rotation off. Because again, I said, kind of when I first called Mike, I was like, well, did something just happen with the yen that I'm unaware of? Did Japan just come out and say they're going to hike rates, or what just happened? Because this looks like the same yen carry trade blow off that we had back in August. But that wasn't the case. So again, the only thing, and again, I may be entirely wrong here because again, that's the only thing I can link it to. Sometimes you don't need a reason, right? Sometimes somewhere some hedge fund said, hey, I'm out, and it just causes selling. That could have certainly been the case as well. So, I mean, there's nothing out there that says this was the catalyst for why this occurred yesterday, but it did. And again, the only thing that made any sense, of course, was this DOJ release. And that would make some sense, right? If potentially Nvidia is on the chopping block by the DOJ for monopolistic practices, that could impact a lot of things, right? So we'll see. I don't know. But it was interesting. It was very interesting yesterday. And no, I don't know exactly if Pelosi sold all of her positions day before. We'll find that out when she releases her next update. But don't color me surprised if she did. So somebody knows something somewhere. Somebody called somebody. Okay. So anyway, but yeah, Treasury bonds did extremely well yesterday in that rotation off. Long duration bonds were up sharply for a moment. For a very brief moment, the yield curve uninverted, and then it reinverted again, but just barely. So we're going to get an uninversion of that yield curve sooner than later. Question is just a function of timing now, really more than anything else. But again, that yield curve will uninvert at some point, and as we said earlier, that will officially start the clock for the potential. And again, there's no guarantee of anything, and again, nothing is guaranteed in the markets. This time can be different for a whole lot of reasons. But historically, the uninversion starts the clock for a potential recession. And as I said, with the economy now being 80% service-based, the number to look at for any type of real weakness in the economy, and I suspect that on Thursday, when we see the ISM services release, that will come in down from last month. So in the previous two reports, ISM services were negative. They were below 50. That's contractionary territory in the report before last. Last month's report was back into expansion, and it's been and ISM services has been all over the board lately. It's got a big reading one month, a big drop the next month, a big up reading the next month, big drop the next month. It's been very volatile, and it's a very unusual. ISM services is usually not like that, which suggests that there's probably some data issues somewhere in the collection process. But it's expected on Thursday that number was 54.1 50.9, 51.4 previously, expected to be 50.9 on Thursday. Now, that's still expansionary, right? You're still above 50. But what's important about services is the trend of that data, and that trend is still clearly negative from over the last couple of years. So the economy is clearly slowing down. We're not into contraction mode yet, unless that number comes in a lot weaker than expected on Thursday. We'll see. But again, it's got to stay there more than 1 month. That number has been negative this year a couple of times. It's been below 50 a couple of times this year. And then, like I said, the next month, it magically pops back up. There's not a consistency to the data this year to really determine what it means. So we need that data in order to determine if a contraction in the economy is coming. ISM services needs to be below 50 for 3 months in a row. That will give you a much better indication than a 1 month number. But again, we'll be paying close attention to that on Thursday because, again, that's 80% of the economy. And it tells us a lot about where we're potentially headed. Okay, quick break. We'll come back. More stuff to get into. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife has this KitchenAid mixer. I bought it for like 15 years ago. And this is before, I guess, the invention of lighter materials. I'm not sure. Brent's nodding his head. This thing probably weighs a good close to 100 pounds.
It's a boat anchor.
It's actually shaped like a boat anchor.
The Real Investment Show podcast.
If you ever lose a boat anchor, just throw a KitchenAid back there. It also works as a propulsion system.
At realinvestmentadvice.com.
I'm not banging on KitchenAid. They're awesome.
It'll run forever.
And they run forever. Need to get rid of body. Just
tie a KitchenAid to it.
Tie a KitchenAid to it.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Denny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So over the next 2 months, as we talked about yesterday, and also this was in the article that we produced yesterday as well, that, over the next 2 months, there's several risks that are kind of facing the markets, and we discussed those quickly yesterday. But, basically you've got the upcoming election, policy and, policy measures, et cetera. And it's interesting because there was a poll out yesterday asking, supposedly, and again, you kind of take polls with a grain of salt because it's who you actually ask and how do you ask the questions. I can create a poll that will tell me exactly what I want it to tell me just by simply phrasing the questions properly. I can lead the horse to water, so to speak. So if I want you to, vote affirmatively for some action, I just word my question in a way that gets you to give me an affirmative answer. So polls are very iffy, right? But it was an interesting poll yesterday just talking about policies. And the question was simply, do you understand the policies of each candidate? And a vast majority of the people they polled have no idea of policies, right? They're simply voting on whether they like a person or not. I'm voting for Harris because I hate Trump, right? That's the reason for their vote. It's not about policy, but again, policy matters, and it matters a whole lot to the future outcomes, and specifically, as we're talking about today, specifically to the markets. What policies are going to impact the markets if they get passed? And again, this is this is a huge question, right? They're both on the campaign right now spewing out all kinds of policy ideas. We're going to eliminate tax on tips, right? Okay, even if you get that passed, that's 2% of workers. That doesn't really help much of anybody other than if you happen to be in the service industry and getting tips. But it's a very small percentage of the economy. So it sounds great. It sounds like, and both camps are promoting this, right? So this is both a Democrat and a Republican policy incentive, but it's a very small thing. This doesn't move the needle in terms of fixing the economy. So, we've got to think about, the bigger policies. And the reality is that most of the bigger policy initiatives have very little chance of passing unless, and again, this is why, just focusing on who you like for president or not really doesn't matter. What really matters is who you vote for in the Senate and Congress, because if you have a Republican president and Democratic Senate and Congress, nothing's getting passed, or vice versa. If you have a split Congress, nothing's getting passed, vice versa. So all these policies sound great if people really even understood the policies that they were voting for, but they all sound great, but again, whether or not you can get them passed is entirely different. But there's a few things that, in a recent update on kind of the policy agenda of both candidates were kind of interesting. So Harris wants to raise the corporate tax rate from 21% to 28%. Trump wants to lower the corporate tax rate from 21 to as low as 15. Neither one of those policies are likely going to pass. But again, this is kind of what we're voting for. So, if Harris wins and she does, and so let's just assume that in each case, the person that gets elected can pass these policies, right? Now, the reality of raising corporate tax rates a huge degree or cutting tax rates to a huge degree probably won't pass. So and again, Trump tried to get corporate tax rates down to 15% under his previous watch. He got it to 21. He was down from 28 to 21, but he had to negotiate to get it to 21. So going from 21 to 15 or going from 21 to 28 probably isn't going to happen. There'll be some negotiation in the process to get something done, and we'll see. But in reference to the markets, hiking corporate tax rates isn't great because two things are going to happen. And just think about this logically for a moment. If I'm a business owner and you raise my tax rate, I have to compensate for that increased tax rate in the prices of the goods or services that I sell. So that increases the cost on Americans. So you have higher prices. Now, you've got both candidates promising to get rid of inflation, but now Harris is potentially producing a policy to go after more taxes, but that will lead to higher inflationary pressures because that cost has to be passed on. Or if it can't be passed on because people can't afford the cost difference, it impacts profit margins and earnings, which with markets that are priced for perfection on future earnings, that has an impact. Now, obviously, if I can cut corporate taxes, that's a different story. Tax rates in general. So Harris wants to basically support the Biden plan to allow all the tax cuts to expire, the 2017 tax cuts, allow those all to expire, and except for those that are earning less than $400,000. Now, importantly, taxes have gone up, even with those tax cuts for all Americans. We've seen higher taxes getting paid. And this year in particular, some of those things are getting phased out. Trump wants to make those 2017 tax cuts permanent. As we've talked about before, the problem with taxes in general is that taxes impact everyone. So if you want to raise taxes on those making $400,000 or more, which is kind of the Harris plan, that we assume that that's going to remain isolated in a little bubble. So just people over $400,000 are going to wind up paying more taxes. It never works that way. Those tax rates will pass down. Now, either individuals will wind up paying more income tax in some form or measure, or they will wind up paying higher prices. In other words, they'll be taxed through consumption as those higher taxes on business owners, et cetera, are passed through their products. Again, this is the important thing to understand about taxes. And this is why, as we talked about the other day, why the founding fathers came here in the first place was to get away from taxation without representation, because it impacts everyone. There is no free lunch with taxes. You cannot only just tax one small group of people. Top 10% of people pay 90% of all the taxes. What are you complaining about? Right? But we have this whole idea that the rich need to pay their fair share, but they're already paying that and more. And if you want to see the impact of that, that gets reflected in the prices for things that you pay. Affordable Care Act, one that's as you know, it's interesting here because, you know, we've talked about the Affordable Care Act ever since 2008. Everybody complains today about the problem with healthcare, right? It costs too much, can't get insurance, can't afford insurance. But that was the whole premise, with quote fingers up, behind the Affordable Care Act to begin with, which was it was supposed to lower the cost of healthcare for the average American. And it was also supposed to solve the problem that the bottom 20% of Americans that were uninsured, those people could be insured. And we set up these exchanges all around the country. We spent hundreds of millions of dollars setting up these healthcare exchanges around the country. Every one of them have failed. All those tax dollars spent for those exchanges were a waste of money. Cost of healthcare has gone up markedly since the Affordable Care Act was launched, and that was because you inserted another entity into the patient healthcare provider process. So whenever you insert another party between the patient and the provider, it's going to increase costs because you've got to pay for that third party. So the government's got to make money on this. So what do you think was going to happen? So healthcare costs have gone up markedly. Now, the policy prescriptions here by Harris is to extend or make permanent temporary subsidies for higher income Americans to buy insurance through the Affordable Care Act, forgive some medical debt. Why are you having to provide, now here's the whole question. If this is the Affordable Care Act, why are you having to provide subsidies for higher income Americans to be able to afford health care? Just a question. Trump wants to repeal the Affordable Care Act entirely, which is a different measure. The problem, as Ronald Reagan once said, is that once you have a government policy, it is impossible to repeal it. And there have been multiple attempts to repeal the Affordable Care Act to put policy prescription back into the hands of the average American, but every one of those fail. Again, now that there are people on this, it's very difficult to repeal a subsidy once you've already given it to taxpayers. They don't like that. So it's going to be very difficult to repeal it. But the cost of health care is going to continue to remain elevated as long as you have a third party in that process between between the patient and the provider. Actually, I should say a fourth party, because right now you should have patient and provider working that out. The insurance company should be, an option on that, but they're in the third party, and now you've added a fourth party, which is the government. But that's going to have impact, of course, on healthcare costs, how much people have money to spend, and how that reflects into the economy. So again, lots of different policies that are being promoted by both parties. The realization is that very few of these will actually ever pass unless you have control of House and Senate. But they all have an impact on the economy, the economic prosperity of individuals, and ultimately on the markets. All right, quick break. We'll come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show, of course. Get ready to wrap it up for the day. Interesting article is that, interesting comment in our chat today is that there's sugar in everything, including the bacon. Of course there's sugar on bacon. If you've never had maple dipped bacon, I don't know where you've been living. Yeah, of course there's sugar in bacon. It's the only kind of bacon there. I don't get to eat it, mind you. But I certainly enjoy watching other people eat maple bacon. I like to live vicariously through other people. I'm on this super strict diet right now. I told y'all a few weeks ago that I took my kids to go see it sounds like my kids are like 4. I took my kids to the movie the other day. My kids are in their 20s, 19, 20, 21. So, but they wanted to go see the new Wolverine Deadpool movie. And so I was like, sure, I'll go because I enjoy those type of movies. I have a weird sense of humor, if you can't tell. So I took them to the movie. And of course, Hugh Jackman is just completely ripped in this movie. So immediately after, and he's 50, don't quote me on this. I believe he's 55, 56. He's very close to my age. I'll be 60 in this coming May. And so he's very close to my age. I was like, man, he looks great. I got to go look at what his routine was. And so I went and looked up his workout routine and his diet that he's on. And I can't do his diet because he ate 8,000 calories a day while he was training for this movie. I just cannot consume that much. But the exercise routine is killer. I am sore like every day right now because of that routine. But anyway, so I am incorporating a lot of the diet. So right now there's like no sugar, very low carbs, and and like I can't eat any of the things I like to eat, of course. But it's brutal, but it works, right? It's working very well. So taking off a lot of excess body fat and getting where I want to be. So, but it's sore every day. But anyway, it's interesting. Yes, there's sugar in bacon. And there's sugar and actually there's sugar in most everything you consume. If you read the back of labels, which is incredibly important, you should read labels. If you're trying to lose weight and be healthy, read your labels, and particularly read how much sugar is in the items that you eat. And you'll be surprised, even in protein bars, like Cliff Bars as an example, they're promoted as healthy protein bars, right? You should go, if you're going to go out hiking or whatever, that's great. Eat a Cliff Bar. Those are the commercials. 26 grams of sugar in a Cliff Bar. Extreme. I mean, you might as well eat a Snickers bar at that point and it'll taste better. Actually, Cliff Bars aren't bad, but but extremely high in sugar. So, you've got to really be careful about, what you eat. Read your labels, fat content, the type of fat that's in it, that you consume. You'd be surprised in what Whole Foods are the best, obviously not Whole Foods Market. That's just stupid expensive. That's whole paycheck. But eating whole foods, not the market, the actual product, is a much better way to go. And you'll feel better, and you'll be healthier, and you'll lose weight and those type of things. And again, as Danny and I have talked about before, as we move later into retirement, you're going to be spending up to $350,000 of your savings on healthcare, just because most people don't take care of themselves. So anyway, sorry, I digress, but that was an interesting comment about sugar and bacon. Yes, sugar is in bacon, and damn, is it good. So, speaking of sugar, let's talk about the markets. Interesting chart out this morning. I want you to take a close look at this chart for a second. I'm going to just leave this up for a minute because there's a few points I need to make. I want you to notice something about this chart. This is assets in leveraged and inverse exchange traded funds. So basically, how much money is in leveraged funds one way or the other. And so this is 2x funds up and down, 3x funds, etc. So notice that between 2009, coming out of the bear market, and again, a lot of these didn't exist prior to the financial crisis. Most of the ETF development has occurred since 2009. If you take a look at pull up most ETFs, it's like, oh, it started in 2010, 2012. That's all the history there is to it because they haven't been around that long, particularly in the leverage side. But it was interesting between 2009, 10, 11, 12, you had basically about $30 billion a year, give or take, flowing into these leveraged ETFs. And then take a look at 2020 when we sent checks to households. And, every kid on the planet jumped onto the Robinhood trading app with their $1,500 stimulus check to trade stocks. Notice what's happened since then. You had almost $110 billion this year so far going into leveraged ETFs. Now, the stock market's, trillions of dollars. So 110 billion certainly doesn't sound like that much money, right? But what this shows you is the speculative nature of investors today, which ultimately always, and again, a lot of these players in the leveraged ETF space are retail investors. These are, young kids, trying to get rich quick in the markets. Oh, I'm in the 2x Nvidia, leveraged ETF. That worked great until yesterday when, the stock's down 10% and your ETF's down 20% in a day, right? Stinks. And then this is one of the things that people forget about leverage. Leverage is great on the way up, but leverage is a double-edged sword, right? It cuts you just equally as bad on the way down. And you've got to remember that about taking on leverage. And again, we haven't had a real bear market of any consequence. We had a correction in 2022. It was mild. But we haven't had a real significant downturn in the markets to where you evaporate leverage. And this has really, and again, leverage has two sides to it. Leverage is great on the way up. It helps fuel the market, right? If I can leverage my positions, I can buy more, right? I can go into margin, buy more stocks. Leverage works great. But the unwinding of that leverage is rather dramatic. And when you have, and again, this isn't just the only example of leverage out there. This was just an easy one this morning that I ran across when I was doing my Twitter post this morning. But we're going to see, when we get into a downturn, again, this is unfortunate. A lot of young investors, retail investors, are going to learn the rules of investing the hard way. And this is the way that most investors learn their rules. And two things happen. One, they get wiped out and they never come back to the market again. Or when they do come back, they're extremely cautious. And they go, okay, I'm not going to make those same mistakes again because I lost all my money and now I've got to try to get it all back. But that's going to be the consequence of leverage in the markets. And again, we fuel this speculation, right? And again, as we talked about yesterday, Wall Street's job is to sell you a product. And so if you're demanding more leverage, they're going to give you more leverage ETFs. Oh, look, this fund company issued out a 2x S&P 500 leveraged ETF and they raised $100 million in assets. I'll do the same thing. And I can go get $100 million in assets because obviously there's demand for that. Right? I can do a 2x leveraged Nvidia ETF. And so they do it and somebody else does it. But as long as there's demand for something, right, Wall Street's going to issue a product for it. They don't care about if you lose money. They're not there going, hey, you should invest in this ETF because it's going to be great for you long term. They don't care. Right? They're just trying to capture the fee run right now. And so if I can issue out a product and capture, a couple $100 million from you, great. I make profits. It's not good for you, but I'm not going to tell you that. But again, but since 2009, we have not had a real correction or a real bear market of any consequence. We've had some corrections along the way. 15, 16, 2020 was a correction. 2022 was a correction. We haven't had a real bear market. We've not had something that has basically, my daughter would say, shook somebody, right? We haven't had that event that all of a sudden makes people quit investing and get out of the market yet. And what leverage does is amplify, you can take the chart down now, Brent, but what leverage does is actually amplify that downturn. And so a lot of people are taking on a lot of excess leverage here, and that's okay. That's what fuels the market advance, and the market feels good when it's going up. As Warren Buffett once said, the market's a lot like sex. It feels best right at the end. And that's where we are in the markets, right? Feels great. Markets just kind of go up every day. The more risk I take, the more money I make. It's awesome. I mean, I've got people on Facebook telling me that, they're just printing money in the markets. That's great. That's awesome. Just be aware that this ends. Now, that doesn't mean tomorrow, doesn't mean next week, doesn't mean next month, that doesn't even mean next year. It will eventually end. There will be a reversion at some point because, as I pointed out in the article the other day, is that the deviations from the long-term means of the markets are extremely elevated. And, I mean, we're pushing extremes in markets that we have not seen in a long time, which ultimately tends to have I should say, leads to bigger issues in the markets. And this is something that I brought up in this past weekend's newsletter. So if you haven't read the newsletter yet, I go through long-term valuations in the markets and long-term deviations in the market. So if you go to the website, realinvestmentadvice.com, click on the Insights tab, go to the newsletter. It's this past weekend's newsletter. But I have some charts in there that are monthly and quarterly that go back through history and suggest that a mean reverting event is likely at some point in the future. And the magnitude of that decline will be impacted by the level of leverage unwinding that occurs during that process. So be careful with leverage. That's what I'm telling you. All right. All right, wraps up the show for the day. Thanks for joining me. Be back tomorrow. Michael Leibowitz is joining me. We'll talk about everything that's going on, the Fed, economic reports, etc. All tomorrow with Michael Leibowitz. Have a great day. See you then.